the street's starting to give more cred to that services business. We believe 400 to 450 billion is that value of the services side. But a big thing here is China. You start to see it inflect in terms of iPhone demand. And look, the haters are out there. Even the New York City cab driver was negative on Apple going into the print.
Wait. First of all, you took a cab and not an Uber or a Lyft. But second of all, your driver actually saw the earnings, saw the stock response, and was negative?
Look, I could tell you, I legitimately been in cabs in New York City, and guys are negative on Apple. And fundamentally, it speaks to every investor I've talked to was negative on this. And that's why it's not seeing forest through the trees. We believe this is a stock that makes new highs. And right now, it's the 1-2 punch, and Cook is really bringing the mojo back to Cupertino.
Steve, let's talk about the services piece first here. A lot of that is from the App Store, some warranty things and others that are in the mix. In other words, is this a growing part of the business that is not going to be under competitive threat as it gets bigger? Can it be counted on to put up strong numbers year after year?
It sounds like it. I mean, they really surprised us with guidance yesterday, right? I think it was $1 billion or $2 billion over what the street was expecting. Dan and I were talking about this earlier. And so that shows they're seeing momentum there. They even said we saw a lot of momentum towards the end of the quarter. Remember, towards the end of the quarter is when they announced the new services, starting with Apple News Plus, which went live on that first day. So they're clearly seeing signs that these services are going to start to take off. And once they launch with the new Apple Card later this spring, and then the Apple gaming service, and then the TV service later this fall, they really feel confident that even just a small slice of these billion iPhone users out there can really move the needle.
Dan, do you just like the fact that they're not a iPhone company anymore? I mean, as an analyst, does that, for investors too, does that mean they're going to be a safer company to invest in? Does it mean the returns are less attractive or more so?
I think more attractive, because to some extent the frustration over the years has been you have a massive install base, 900 million active iPhones. You want to monetize that. And right now on the services side, they're putting a fence around the backyard and they're monetizing it on the services side. We believe that's only 15% penetrated. And if you compare, let's say, to Amazon AWS, when AWS came out in the margins and Bezos came out with that, that's really when Amazon started to get re-rated. Very similar what's happened with Apple. Once you saw the services margins and what's happened there, I could tell you a lot of my investors, top holders, now you're starting to give that services business a valuation.
You know, Bob Pisani pointed this out earlier, but they have been a buyback monster, so to speak. And it makes their earnings per share look great over the past 5 years, but their net income has been trailing that. So there's the net income figure. It's up 61% from 2013, Dan. But their earnings per share are up 110%. So the EPS is more than doubled, but a lot of that is the buyback. Now, that's not a problem per se, but how much growth does there still need to be left in this company, just pure net income basis, for it to still be attractive?
Look, and that's why I think iPhone plus or minus 5% growth. Where the growth fundamentally is going to come down from is services, which is why, as we've talked about, the streaming services business, what they do on the video side, we believe 100 million consumers in the next 3 years is possible, and that's going to be key to the growth. And it comes down from a valuation perspective. We believe that could add about $15 per share to the stock. That's why right now this continues to go from a glass half empty to glass half full. And we think a re-rating right now is happening in Apple.
100 million, Steve, at a time when Disney's launching their service. You've got Comcast coming. You've got Hulu, which we'll talk about later, putting up some pretty impressive numbers. Are people expecting too much of Apple entering that field?
Out of the streaming stuff, I don't think so, because they have this huge platform, not just from the iPhone, but also you got to think of all the installed base of the Apple TVs. They're moving into smart TVs. You're going to buy a new Samsung TV from Best Buy. It's going to have the Apple TV app right there on there, and you can subscribe to whatever channel bundles you want, whether it's Stars or HBO and so forth. And then they can tack on their own service, the Apple TV Plus, with their own original shows on top of that. Still a lot of questions if that's going to be free or not. But I think another thing we're missing here is the wearables category, which has been exploding. And that is another huge area for growth beyond the services. You can't walk down a street in New York City without seeing half a dozen people wearing AirPods.
Yep.
Apple Watch is growing too.
Yep.
Yeah. So that's a huge other category for them. Plus the Beats brand is part of that.
That's a great point.